Welcome to The Explainer. Today, we're putting on our expert investment analyst hats and throwing a genuinely fascinating stock through a rigorous test we like to call the Guru Gauntlet. We're going to take a life sciences company and evaluate it using the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before grounding the whole shebang in some hard discounted cash flow math. Okay, let's dive into this valuation of Azenta. Here's our roadmap for today. We've got Section 1, the company snapshot. Section 2, the Warren Buffett lens. Section 3, the Peter Lynch lens. Section 4, the Benjamin Graham lens. Section 5, DCF and quantitative models. And finally, Section 6, synthesis and final verdict.
Section 1, the company snapshot.
So meet our subject, Azenta Inc., ticker AZTA. Right out of the gate, this life sciences company is flashing some wildly mixed signals. They provide a full suite of cold chain sample management solutions and multi-omics services for the pharma and biotech industries. Now, if we look at their Q2 2026 results, they pulled in $145 million in revenue. That's up a sluggish 1% year over year. But if you peel back the layers, organic revenue actually dropped 3%, mostly because of some softness in the North American market. To try and refocus the portfolio, they're currently divesting B Medical Systems for a fixed $63 million in cash. And perhaps most importantly for us, management just extended their long-range operational plan all the way out to 2029. Basically, they're signaling that this turnaround is going to take quite a bit longer than originally expected. But here is the hook. $565 million. That's Azenta's current pile of cash and equivalents. And get this, it's paired with absolutely zero debt. Think about that for a second in today's market environment. Just how valuable is it to have an incredibly strong, virtually bulletproof financial foundation like that? However, this creates a massive narrative tension, right? It's like a financial Jekyll and Hyde. On one hand, you've got this seriously ugly income statement staring back at you, showing a $160.8 million GAAP net loss. Though, to be fair, that was largely driven by a massive $149 million non-cash goodwill impairment charge. But on the other hand, you have that absolutely beautiful balance sheet with zero debt. So what do we do with this? How do we value a company bleeding on the income statement but sitting on a vault full of cash? Well, let's bring in the gurus. Section 2. The Warren Buffett lens. So how exactly would the Oracle of Omaha evaluate Azenta's fundamentals? If we run it through his classic scorecard, honestly, it's a really tough grade. Does the company have a wide and growing economic moat? Well, with organic growth down 3%, that moat looks pretty weak right now. Consistent earnings? Not even close. They just posted that massive net loss, and their earnings historically are highly volatile. What about return on equity? Currently sitting in the negative. But debt levels? Buffett would absolutely love the zero debt. That is a huge pass. Still, the negative ROE and the inconsistent earnings would definitely give him some serious pause. Now, you might be wondering about cash. Buffett looks very closely at owner earnings. This is his personal metric for true cash generation. It's basically net income plus depreciation and amortization minus capital expenditures. Because of Azenta's massive non-cash impairment charge, their GAAP net loss is actually pretty misleading. If we strip all that accounting noise out and look at the true cash generation, Azenta reported about $5 million in free cash flow for the quarter. So yes, they are technically generating cash. But here's the reality check. $5 million is a tiny, tiny yield when you're looking at a massive $1.23 billion market cap. For strict value investors, that kind of disparity is a huge red flag. To wrap up the Buffett lens, we have to remember his golden rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Because Azenta's economic moat is currently eroding and earnings consistency is just completely absent right now, Buffett would demand a massive margin of safety. We're talking upwards of a 30 to 50% discount to intrinsic value. At current prices, this simply doesn't meet his strict criteria for a wide moat compounder. He would likely just sit this one out and wait for positive ROE to return. Section 3, the Peter Lynch lens. Now, what's really interesting about this slide is how Peter Lynch's framework completely shifts our perspective toward growth at a reasonable price. Lynch famously categorized companies into 6 distinct types. He'd likely look right past that ugly gap loss and categorize Azenta as a classic turnaround story, or maybe even an asset play. Why an asset play? Well, because of that $565 million cash position, plus the strategic divestment of B Medical Systems, injecting another $63 million into the business. All of those assets essentially create a hard floor on the stock price.
Lynch also loved to look at exactly who was holding the stock. And here we see a fascinating contrast. Azenta is seeing some heavy insider buying. We've got executives like Director William Corna grabbing 10,000 shares at $16 and change, and the president of Multiomics, William Martin, scooping up over 17,000 shares at just over $24. Lynch absolutely loves insider buying. It is a huge bullish signal. But there's always a catch, right? Institutional ownership sits at a massive 70.83%, packed with heavy hitters like BlackRock and Vanguard. For you, as an everyday investor, that heavy institutional ownership means the stock is already discovered. That limits your explosive upside and acts as a pretty big bearish warning sign in the Lynch framework. Okay, assumption alert. Lynch's absolute favorite valuation metric is the PEG ratio. That's the price to earnings multiple divided by the growth rate. But how on earth do you calculate a PEG ratio when GAAP earnings are literally negative? The short answer is you can't. To make this work for Azenta, a Lynch investor has to project future non-GAAP EPS growth based on management's 2029 turnaround plan. Because we're forced to rely on future promises rather than current hard reality, Lynch would definitely view Azenta as a speculative buy. It's only suitable if you truly, deeply believe in that turnaround story.
Section 4. The Benjamin Graham Lens. Let's see if Azenta can pass the godfather of value investing's strict defensive checklist. Step 1. Adequate size. With a $1.23 billion market cap, Azenta definitely passes. Step 2. Strong financial condition. With zero debt and current assets far exceeding current liabilities, Azenta easily passes here too. But step 3, earning stability. Yeah, here is where the wheels completely fall off. Azenta's massive $149 million goodwill impairment drove their GAAP EPS down to a negative $3.49. This completely breaks Graham's requirement for a decade of stable positive earnings. To truly see the problem we're facing, we have to look at Graham's famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. This formula right here is the absolute bedrock of his quantitative margin of safety calculation. So what happens when Graham's formula meets a negative $3.49 EPS? The math literally breaks. I mean, you cannot take the square root of a negative number. Actually, scratch that, an analyst could try to make this work by assuming a normalized, forward-looking EPS based on adjusted EBITDA, but Benjamin Graham, he wasn't in the business of making optimistic assumptions about the future. Because we cannot establish a reliable intrinsic value here, calculating Graham's required margin of safety is just impossible. A strict Graham investor would simply walk away. Section 5. DCF and quantitative models. So the crucial point is, while those guru frameworks give us some amazing qualitative insights, we really need to pivot and ground our analysis in cold, hard, quantitative cash flow projections. If we build a base case discounted cash flow model, we have to forecast out those free cash flows. We anchor our starting point at their reported $5 million in free cash flow for the quarter. Management expects FCF to improve by about 10 to 15% year over year. So we map that steady growth out, pointing toward management's recently delayed 2029 operational targets. Once we forecast those cash flows out, we discount them back to present value. Here, we're running a standard sensitivity table. We assume a weighted average cost of capital, or WACC, of around 10%, and a terminal perpetual growth rate of 2.5%, which basically matches long-term inflation. Depending on how well management actually executes, this model outputs a fair value of roughly $14 to $16 per share. And guess what? That is hovering right around the current market price. The market is pricing in exactly what is happening, a very slow turnaround. We also ran a few other models just to be thorough. An EV to EBITDA multiple approach anchored to their $7.8 million adjusted EBITDA paints a slightly better operational picture than that ugly GAAP net loss. We also did a reverse DCF, which confirms that the current stock price implies extremely low single-digit growth moving forward. And finally, we absolutely must adjust the enterprise value by subtracting out that $63 million cash injection from the B Medical sale. That cash further de-risks the valuation profile for the long term. Section 6. Synthesis and final verdict. And this brilliantly illustrates where we land after running the gauntlet. What do we actually do with this stock today? Let's synthesize the whole thing. Warren Buffett says sell or wait. He demands positive return on equity and a much clearer moat. Peter Lynch categorizes this as a hold or maybe a speculative buy, recognizing that heavy insider buying and the classic turnaround setup. Benjamin Graham flat out rejects it because the negative GAAP earnings totally break his defensive formula. And our quantitative DCFs models?
They suggest a hold, indicating the stock is trading pretty much near its fair value based on current cash flows. Overall, Azenta is a highly transitional, mixed signal investment.
Let's leave you with a final thought to chew on. That massive $565 million cash pile and zero debt provide a very hard floor for this stock. Downside is mathematically limited, but execution must build the ceiling, and management just pushed their targets out to 2029. So the ultimate question you have to ask yourself as an investor is this: does the safety of $500 million in cash outweigh the risk of a messy 5-year turnaround timeline? Thanks for joining us for this explainer, and we'll see you on the next one.